Do you want to know how you can use your risk analysis results for a better financial valuation? Then you've come to the right place. Welcome to my workshop at Risk Awareness Week 2019. The Risk Awareness Week is really an amazing event. It is online, it is global, and it is packed with awesome stuff from the leading experts in the field. So I'm thrilled to be a speaker here, and I hope you get some useful insights from my workshop, which is titled Turning Risk into Value, literally. I'm Thorsten Rohner, and I'm the founder of Psychonomic, a boutique consultancy specializing in building planning and decision support models. Psychonomic is basically me plus a bunch of smart people around the globe, mainly from the US. Some of them are actually giving presentations here at Risk Awareness Week. You can find us on the web at www.psychonomic.com. What's special for a financial modeling firm is that we develop our models with Analytica, a platform that integrates visual model building, working with multidimensional data, and Monte Carlo simulation for explicit risk analysis. To promote the use of Analytica for financial modeling, we run a website at www.beyondexcelmodeling.com. I also developed the Psychonomic financial modeling framework based on Analytica, for which I set up a showcase page on LinkedIn. To keep updated on this, just follow me there. But before we start with the actual webinar, just some housekeeping stuff. If you have any comments or questions, just put them into the chat box here, and I will get back to you as soon as possible after the webinar. I really look forward to having interesting discussions with you folks out there. But with no further ado, let's jump right into today's webinar, which is about turning risk into value. The question is, do we really need a risk premium on top of the discount rate to account for risk, or is there a better way? To be honest, I published an article on LinkedIn quite a while back, which got some nice traction and also sparked some interesting discussions about the question, do we really need such a thing as a risk premium for valuation? And the question is just, how can we translate any business, project, investment, or whatsoever into a value, into a financial value? Or more specifically, how can we translate the risks inherent in these things into a value that reflects the individual level and nature of risk? I started about the problem by asking, what do we really know about financial valuation? What do we know for sure? What is true without any doubt? This is kind of a first principles approach, which seems to be quite successful when it comes to landing rockets that are falling down from space on their back, or developing electric cars, or building cheap tunnels that might solve some of the traffic problems within our big cities. It's about boiling down things to the most fundamental truths and then reason up from there. That said, here are the 4 things I believe we can rely on. First, future cash flows. What we can take for granted today is that financial value can only come from future returns, or more specifically, future cash flows. Not from the performance of the last 10 years, and certainly not from last quarter's results. So it makes no sense to use multiples of any of those numbers or ratios of the present. Only the future matters. The question is just, how can we know about these future cash flows? Well, that's maybe the hardest part, because it requires to understand the business model or the mechanics behind the numbers. If you're not willing to deal with this seriously, you shouldn't try to evaluate or to be invested in the business project at all. The second thing we know for sure is the time value of money. The longer we have to wait for an amount of money, the less it is worth to us right now, and that's why future cash flows are discounted. Discounting future cash flows is the way to translate the timing information into a single present value. But it's not the way to translate the risk information into a value, although the third thing we know for sure is that risk matters, of course. We know that risk matters when it comes to valuation. The more uncertain a cash flow is, the less it is worth to us. If we buy a bunch of uncertain cash flows which provide us on average the same return as a risk-free bond, we would probably go for the bond or pay less for those uncertain cash flows. Simply put, the riskier something is, the less we'd be willing to pay for it. The question is just, how do we translate this riskiness into a value? And here comes number 4, the valuation of uncertainty. The method's been developed in finance, and it's called the binomial options pricing model, a generalized numerical model for the valuation of options. It was first proposed by William Sharpe in 1978 and formalized by Cox, Ross, and Rubinstein in 1979. So it's also known as the Cox-Ross-Rubinstein model. The basic idea of an option is to get rid of the downside while keeping the potential of the upside. This works kind of an insurance that protects from negative values below a certain threshold, in our case, the expected value of a range of uncertain returns. And the question is, what would we have to pay for that option? Because this is the value of riskiness. We should pay less than the average or expected value when we have to bear the risks ourselves. Because this piece is less intuitive than the other 3 things, I think it's a good idea to briefly go through the basic principles here for better understanding. What you see here is a so-called binomial tree. The tree shows the possible price movements of an underlying value, either stock price, currency exchange rate, or whatever. The price of the underlying of the option at each time step can either go up or down. The number and length of the time steps, as well as the discrete up and down movements, need to be calibrated to the risk horizon and volatility of the underlying, of course. But at the end of the tree, we arrive at the possible range of values. So if those values at the end were the possible returns from an investment, what would we pay for it right now? Certainly not the 100, which would be the average, because, well, that's what we would get for sure if there were no risk. What we want basically is to get rid of the values below the average. If we'd find someone who would compensate or insure us for the underperformance of 20 or 40 in this example, what would they charge us for this insurance? Or in finance speak, what's the value of this option? In this model, valuation is carried out backwards, starting with a possible payout at the end and calculating the value of each node as the average of the subsequent nodes. So down here, the average of 20 and 40 is 30. The average of 0 and 20 is 10, and so forth. This way, we arrive in this example at the price of 7.5. And this is basically the price we'd have to pay for being compensated for the risk of a return below the average of 100. In other words, if we bear this risk ourselves, we should only be willing to pay 100 less 7.5, which equals to 90.5. This is a proven concept. It is widely used in the finance industry, and there is no question that this is correct. And here we have the four fundamental truths of financial valuation. We have the future cash flows, which are important. We have the time value of money and the concept of discounting. We have the importance of risk, so risk matters. And finally, we have a proven concept for the valuation of an uncertainty. You see, there is no such thing as a risk premium so far. And the question is, why is it so tempting to use a risk premium for valuation? Well, the simple answer, in my opinion, is it works. I mean, if you put an additional rate on top of your discount rate, you get the effect you want. The higher the discount rate, the lower the present value. This is exactly what you want to achieve. The problem is just, how do you determine the right risk premium? Now, the only thing you know really for sure is that if the cash flows are uncertain, you would have a lower present value. Well, maybe we should simply change our perspective. I like to use this analogy. When you look at the skies, it's easier and more intuitive to believe the sun is revolving around the earth. That's simply how it appears to be. It somehow makes sense and seemed to work at first. To discover and admit that the earth is actually revolving around the sun requires a broader perspective and a more systematic way of thinking. Of course, you might be able to describe much of what you see in the skies with a geocentric model, but it's much more complicated and requires much more tweaks to be consistent with the observations, let alone the fact that the Earth is not in the center, of course. In the same way, you might be able to come up with all sorts of reasoning and calculations to justify an appropriate risk premium. But in the end, it's all more astrology than astronomy. So the fundamental question is, where should we account for risks and uncertainties of the future? Just put a somewhat arbitrary risk premium on top of the discount rate? Or should we put the risks where they actually are, in the cash flows? After all we've heard right now, you shouldn't be surprised when I say I'm more in the camp of the latter. So for turning the risk information into financial value, we need these three things. The first thing is we need to capture what we know about the business model, about how this thing we want to evaluate is supposed to work. That means we need a planning model that doesn't start with the numbers, but with the business logic behind those numbers. We call this a driver-based model because we model everything that drives the financials. In this example here, we have a little sales model that calculates the effects on the financial statements. Ideally, the model should do this in an integrated way so that we end up with a consistent set of income statement, cash flow, and balance sheet. This is the ideal world. This is what I'm doing with my models. The good thing is, if you use this approach, you can do this for every part of your model, not just for sales, but for supplies, for financing, for CapEx, or whatever. You can think of this idea as having a standardized port that connects any kind of business logic with the financials. And this is really the concept behind this economic financial modeling framework that I developed. And I will show you this example model here later in the workshop. So a driver-based model is the first building block we need. It captures everything we know about the business, about the project, or whatever we want to evaluate. The second thing we need is about what we don't know. This is everything related to risk and uncertainty. The future is full of uncertainty and risk, yet many financial modelers ignore this when they build their models. So for this, we need a planning model that doesn't rely on single point estimates, but use the full range of possible values. The input of our planning model must not only contain the things we know with certainty, like last year's numbers, existing orders, or a loan repayment schedule, but also the things we don't know exactly, but should know or would like to know. And the vast majority of model inputs are uncertain. You have uncertain commodity prices in the future, or an uncertain demand for your products in various markets, and the list goes on. Basically, every input of your model is uncertain because it deals with the future, and the future is uncertain by nature. The good thing, though, is that for every uncertain variable in our model, we can always define a range of possible values. There are techniques that allow you to find out the P10, P50, P90 quantiles and construct a probability distribution around those numbers. And as soon as we replace single point numbers with probability distributions, the output of our model is also a range of possible values. So we can look at any number, any output of the model in a probabilistic way. For example, you can display future developments as probability bands, or a certain period result as a probability density curve, or, if you like it better, a cumulative probability graph. In short, what we need to do is to showcase the whole picture, because the interesting information is in the margins and not the average. You might have heard of the famous statistician who drowned in a river that was only 3 feet deep on average. And if you're lucky, you might have also heard of the flaws of averages firsthand from Sam Savage this Monday here at Risk Awareness Week. The message here is get rid of those single point values and single point calculations and use an explicit risk analysis instead. With this explicit risk analysis, we have our second cornerstone for our valuation framework. After describing what we know about the business logic with a driver-based model, we now have described what we don't know, the risks, the things that are uncertain. The remaining thing we need is actually very simple. It's to find out what we would pay for that business opportunity or that project or whatever we're looking at here. For this, we need a valuation model that doesn't play with a discount rate. Of course, there's a Dilbert cartoon for everything, so also for the use of discount rates. It says, for everything you do in your model, you have, of course, to use the right discount rate, otherwise it's meaningless. And that's really the crux. So the question is, how can we do better? How can we calculate the net present value without that strange risk premium thing? What we know from our Monte Carlo simulation is the potential range of the free cash flow in the future. But we also have every single scenario produced by the Monte Carlo simulation. And if we use every one of these scenarios, there is no need to add a risk premium to our discount rate, because every scenario in itself has no risk. It is just one of many that can happen in the future. So if we use a risk-free rate as our discount rate for translating, remember, the future cash flows into a present value, we will of course get a distribution of possible NPVs. One thing that's often brought up by people is there really a risk-free rate? But that's pointless here. So I'd rather refer to it as the rate of the least risky alternative you have. If this rate already contains a risk premium for anything, so be it. But this is your benchmark. If you have any comments on this, I'm happy to discuss this separately with you. But now we have still the problem of converting this distribution into a single fair value. And here comes the options pricing theory. And remember, the expected value is not the price you would pay for the distribution. Only if you get it for sure, but you don't. You have an upside, but also a downside. So for bearing this risk, you'd probably pay slightly less than the expected value. The question is just how much less. Maybe the binomial options pricing model can help. In a sense, this binomial tree is like a baby Monte Carlo simulation. These simple up and down movements are something you can model in a random walk model that would generate different paths like this one, or this, or this, or that. You can also calculate the probabilities of every possible value along the time horizon. This way, you end up with something like this, a probability distribution of possible values. Now, when you apply the same logic as in our simple model before, that means when you want to get rid of the downside values of the distribution, you simply need to do the math. Just multiply the probability of every value with the compensation payout, and you get the value of the potential downside. You see, the math for calculating this negative value of risk, as I like to call it sometimes, is pretty simple. No fancy equations needed. It's really that simple. And no surprise, this value is exactly the one you would get from the traditional solution we've seen before. That means with an explicit risk analysis using Monte Carlo simulation, we can very easily calculate the value of the risks inherent in our business cases, projects, or whatever. Now, how does it look like in real life? So, okay, let me show you an example from a simulation model in Analytica. What you see here is a table of simulated net present values. Next column simply shows the average or mean of these NPVs. In this column, you have the actual calculation magic. It's simply the difference between the simulated NPV and the mean value. If the simulated value is below the mean, you use the difference, otherwise it's 0. These numbers are the payouts for someone who would have to compensate us for negative performance. This is for NPVs that are below the expected or mean NPV. Here you can see the probability distribution of these differences. You see a big spike at 0 because in roughly half of the simulations you would get NPVs above the average and then values to the left. You can also display this distribution as a cumulative distribution if you like. Finally, what we need to calculate is simply the average or mean of this blue distribution. This gives us the negative value of risk of 45K in this example. And this is the amount we should deduct from the expected NPV of 129K as a compensation for the risk we're taking. So the fair value of this risky business should be around 75K instead of the expected 129K. As I said, it's that simple. No complicated calculations. Everyone can understand how this works. With this option-based valuation, we have our third and final building block. For briefly wrapping this up, these are the three things we need to apply this valuation approach. First, a driver-based model that captures everything we know about the business, the project, the investment. Second, an explicit risk analysis that quantifies and makes transparent what we don't know, the risks and uncertainties. And this is the core of everything related to decision making. And third, an option-based valuation using proven methodologies from the finance industry based on a Monte Carlo simulation of future cash flows. And again, the value calculation is the simple thing you can imagine. The hardest part is in the model and in the risk analysis. If you want to calculate the true value of risk, you need to put everything you know into your model and everything you know about what you don't know, the risks and uncertainties. If you left something out that you know, it's your fault. But you don't have to. You can model everything. And you can describe every risk as a matter of fact. So with this simple approach, we can truly translate every business logic, every project, every investment into a financial value. This is turning risk into value, literally. Now, after all this theory, you might want to see a demo of how that could look like in reality. I will give you the demo, no worries, but before, let me briefly give you some context of what you're gonna see. The model I'll show you is a business case example I borrowed from my friend Rob Brown. Although a fellow Analytica enthusiast like me, he published a book titled Business Case Analysis with R. Not because R is better suited for business case analysis than Analytica, but for the much larger R user base. Anyway, I use this business case because it's simple enough to convey a big picture idea, yet challenging enough to deal with the typical uncertainties in corporate decision making. As you can see here, the entire business case model, along with the relevant financials and value calculation, fits on one screen. The left part contains the actual business case model, as I refer to as the operating model, in contrast to the financial model that deals with income statement, balance sheet, and cash flow statement. It represents everything we know about how the business case is supposed to work. The pale blue ovals are the model assumptions. This represent the uncertain inputs to our model and describe in the form of probability distributions what we don't know. The part of the model to the right calculates the net present value of the business case and also the fair value given the inherent risk and uncertainties. But now let's really jump into the demo. Well, okay, what you see here is an Analytica model of the business case example. Well, it's not exactly the model itself. It is more like a description of the business case or an intro page. It's one of many ways you can create user interfaces in Analytica. You can combine descriptions with parts of the model. In this case, the model inputs or assumptions that go into the actual business case analysis. And these objects or nodes are not just nice little pictures, they are really parts of the model and really contain the definition or formula to calculate the numbers. If you open an object, you'll see all the necessary information about that object. The title, the units, the description here, the definition or formula to calculate the numbers, and even the inputs and outputs of that object. And since these objects here are just links or aliases of the original nodes in the model, you can easily navigate to the original node to find out what the logic of the model is. So here you see the sales model. It's the place where revenues are calculated based on the assumptions of the business case, the time to peak sales, the market demand, and the price of the product. All of these assumptions are uncertain. That's why they are represented as light blue ovals. You can also have constants like the ton to kiloton or the pounds to ton conversions. And you have an output node that holds all the direct effects of the sales model that go into the financial statements. In this case, just revenue and cash receipts for customers. So as you can see here, as I scroll to the right, okay, as an experienced analytical user, you can also see that there are connections to other parts of the model. Those little arrows to the left are indicating that there is some input from somewhere else. Let's check where it comes from. The phase 1 construction duration in the CapEx model. So obviously there is a sales as well as a CapEx model. Let's see what else this model consists of. Here at the top of the model diagram, you see this navigation strip. It tells us where in the model hierarchy we are at the moment. Obviously, the CapEx model is within the business case analysis, so let's jump right in there. We see there is the CapEx model that goes into the sales model, but also a competitive risk model that goes into there. And the sales model obviously delivers something to the OPEX model. Great. You see, you can organize an analytical model as a hierarchy of nested models. We call these modules of the model. And you can have as many as you like or need. For example, this module here contains everything that's in the entire business case model to give you an overview of the whole thing. That's the one I showed you in my presentation slides. Everything you see in this diagram here is from the real model, but in fact it is just like a link or alias object. So you don't have multiple versions of the same thing in your model. It's only a so-called virtual twin of the real object. Here we have our market demand input, and you see we can easily jump right to the original place in the model. Now, we don't want to dwell onto the calculation details of the model, but let us walk down the model logic here until until we reach the thing we're interested in, the net present value. When we evaluate the model or the object, we see that the NPV is no single value, but a distribution of possible values. That's what we've seen before. We can look at this distribution various ways and also examine the individual Monte Carlo simulations if we want. But to get to the risk-adjusted NPV, we just need to calculate the mean of the simulated NPVs here, then calculate the differences of the simulations and the mean if the simulations are below the mean. You see the calculation logic here. And finally, we just need to calculate the negative value of risk. The negative value of risk as the average of those differences, which we then just need to deduct from the mean of the NPV, as we've shown before. Not very complicated once you have a simulation model of your business case, right? This compare node here, by the way, just collects the data of the calculation nodes I've just mentioned. This is the same table I showed you in the presentation. So you might be wondering if we can calculate a risk premium from this if we want. Well, for this, let's jump into the actual calculation model where I did some little calculations to check that. Here you have the NPV calculation again, along with the cash flow calculation logic for this little business case. And down here, I put together a little model to calculate the internal rate of return, or IRR. This is the return you get from the project's cash flow after you have invested the amount of the risk-adjusted value we've calculated. So first I created a timeline for the investment that has a prior time bucket, which is meant to hold the amount of money we invest in the business. This should be the risk-adjusted NPV we've just calculated. You see there is an error from the risk-adjusted NPV going into the investment cash flows, and another error from the cash flow of the business cases. When we look at the calculation logic, we see that we assign the risk-adjusted NPV as a negative value to the prior time bucket of the timeline, and the other periods of the timeline are filled with the cash flows of the business case. Now, let's look at the numbers briefly, just to check if we did it correctly. Okay, seems we did it well. A negative cash flow of our investment, followed by the project cash flows in subsequent years. And of course, we have many ways to display those cash flows. The mid value, this is using the P50 values of each input. The mean of all simulations, the probability bands, or even the individual simulation values. When we now calculate the internal rate of return for our investment, we see that this is also not just a single value, but a range of possible returns. They can be obviously very negative or quite positive. So the use of the lower than average risk-adjusted NPV as our investment value doesn't reduce the uncertainty of the investment, but it increases the expected return. Let's check this here. So the mean IRR of this first scenario here is somewhat above 8%, while the discount rate we've used is just 5%. Might the difference probably be the risk premium? Well, of course it is. What else should it be? So finally, we must state that there is really a risk premiums that compensates us for the risk we take in the business, in the project, or whatsoever, but it is not the input of our valuation. Only after carefully analyzing the uncertainties in the business case, we can eventually calculate that risk premium if we want. But it's not an input to the equation, it's an output, nothing more. But before I let you go for today and leave you with your thoughts, which I hope you'd like to share with me or with others, let me show you one more thing. Having a risk-adjusted value is a good way to compare different business cases, strategies, or scenarios, but ultimately, you should also be aware of the full range and shape of the uncertainty, and also of the individual contribution each uncertain assumption makes to the overall uncertainty. So, since we use the economic financial modeling framework here, we not only have an integrated financial model of income statement, balance sheet, and cash flow, we also have various ways to analyze risk and variances. While the variance analyses give us more of the traditional deterministic view, like this one here, or this one maybe, the built-in risk analyses are much more insightful. Maybe the most powerful is something called tornado analysis, which compares the relative impact of the individual model inputs or assumptions based on their range of uncertainty or of a standardized variation of plus minus 10%. This table here contains all the values that are used. You see, there are the P10 and P90 values, as well as the base case, which is the P50 value, and the percentage variations. So when we run the calculation, Analytica calculates for each variable at the time the net present value for each of the different values while holding the others at their base case. The result is then shown in this form here. The model inputs listed according to the importance, which is the change of the NPV when they are at their low or high values. Since the bar chart typically has this V-shaped form, that's why it's called the tornado analysis or a tornado chart. And this is a very powerful tool to determine which inputs and assumptions are most important. So we can figure out, for example, if there are ways to maximize the likelihood of having those variables at their high or low value, whichever is the best for us. Or we can determine what might be the best candidates for doing additional research to reduce their uncertainty. This is what leads to the field of the value of information concept that is covered by other speakers here at Risk Awareness Week. So I hope you enjoyed this webinar. If you did, please share this talk and post key points to social media. I'd be happy to hear from you, either via your comments here or reaching out at LinkedIn or via email. Thanks for watching, and hope to hear from you.